Did you know there's over 600 billion euros in hidden bank losses? Or that 19 countries are showing rising debt trajectories? And that Europe's economic engine is showing signs of serious structural stress? If these numbers are real, why isn't anyone talking about them? This isn't a warning anymore. The data pattern suggests something has already begun. Right now, something dangerous is happening across Europe, and it will impact the United States, United Kingdom, Australia, and Canada. Most people don't see it yet. It's not a sudden crash. It's not a dramatic headline. It's a pattern. Slow, quiet, and it's accelerating. Multiple European countries are showing debt trajectories that are spiraling upward. Major economies are contracting month after month, and the numbers just keep getting worse. Data trends suggest Europe is entering a long-term decline, quietly, slowly, and the response so far has been minimal. Think about that. This is the most unstable financial period in modern European history. Not because of one catastrophic event, but because 3 long-term negative forces are now moving in the same direction at the same time. First, debt is rising faster than economic growth. Second, energy costs are climbing higher year after year. And third, banks are showing stress indicators on a dangerous upward path. These aren't predictions. These are active data patterns shaping Europe's future right now. And what happens in Europe doesn't stay in Europe. Global markets from New York to London, from Sydney to Toronto will feel this shockwave. But here's what makes this different from every crisis you've seen before. Governments are now borrowing money just to pay the interest on their existing debt. When that pattern starts, history shows us exactly what happens next. Let that sink in. Now, you might think this just sounds like standard economic concern, but look at this chart for a second. There's one number buried in the European Central Bank data that changes everything. And when I show you what it means, you'll understand why some analysts are calling this unprecedented. So here's where it gets worse. Let's talk about Europe's debt problem. Because it's not just high, the trajectory is accelerating. Italy's debt has climbed to 150% of its GDP. France sits at 111%. Spain has reached 109%. Belgium is hovering around 106%. Countries across the developed world are watching nervously, from Washington to Canberra, from Ottawa to London, because when Europe sneezes, the world catches pneumonia. But here's the truly alarming part buried in the latest European Central Bank data. Many European governments are now borrowing new money just to pay the interest on their existing debt. Think about that for a moment. Historically, when countries reach this point, the trajectory leads to one of 2 outcomes: default or restructuring. There's no third option. And this is the detail governments don't want you to hear. The clock is ticking faster because of what's happening with energy. This is only the beginning. Europe's energy crisis isn't fading. The data suggests it may be becoming structural. Since 2021, electricity prices have been climbing in many regions. Natural gas costs have tripled in several markets. Industrial output has declined for 7 straight months. This pattern alone should concern every European household and every investor in the US, UK, Canada, and Australia with European exposure. Germany's factories show signs of deep, accelerating stress. Production is declining. Orders are vanishing. Entire industries are beginning to relocate to Asia and North America, where energy costs remain competitive. Look at this evidence. BASF, Europe's chemical giant, moved significant production to China. Volkswagen is closing factories for the first time in its history. ArcelorMittal slashed European steel production by 30%. Many analysts warn this isn't temporary restructuring. The pattern suggests something more permanent if current trends continue. When major industrial capacity leaves Europe, the data shows it rarely returns. For investors in New York, London, Toronto, and Sydney, this means European stocks, bonds, and currencies may be entering a prolonged period of volatility. Who will reverse this trend? But if you think the debt and energy patterns are concerning, watch this number. What I'm about to reveal about Europe's banks will make your blood run cold. Because this is the hidden trigger that could cascade through the entire global financial system. And the data shows it is already developing. And this next part is the real breaking point. European banks are experiencing a stress pattern that has been rising steadily since 2022. The ECB quietly reported over 600 billion euros in paper losses, and that number continues to climb. Here's why this matters to everyone watching from the US, UK, Australia, and Canada. European banks hold massive amounts of government bonds from countries whose debt trajectories are already rising. So if even one country hits a funding crisis, bond values drop, bank losses spike, credit tightens, other countries face higher borrowing costs, and the pattern repeats. This is eerily similar to what we saw before 2008. But here's the critical difference. Europe says its banking system is stable, but the ECB numbers tell a different story. Officials say the risks are contained, but the data suggests containment may already be failing. In 2008, governments could borrow and bail out banks. Central banks had ammunition. Debt levels were manageable. Today, Government debt is near historic highs. Central banks have limited room to maneuver. Fiscal space is constrained. If the banking stress in Europe gets worse, who's going to bail out the banks when the governments themselves are drowning in debt? Let that sink in for a moment. If these patterns continue, Europe could face a severe credit crunch, where even profitable, healthy businesses can't get a loan. Economic activity could just freeze up. Unemployment could surge. Right now, the banking system is flashing multiple stress signals that economists usually see right before a major crisis. And here's what makes this so dangerous for global markets. Major American, British, Canadian, and Australian banks all have significant exposure to European debt. When European bank stress gets worse, history shows that contagion can spread like wildfire across the Atlantic and the Pacific. Your pension funds? They likely hold European bonds. Your own bank? It might have counterparty risk you don't even know about. Your investment portfolio is probably far more connected to Europe than you realize. This isn't just Europe's problem. This is a globally interconnected risk. Think about that. Now, let me show you something truly shocking. There's one country whose path will determine everything else. And what's happening there right now is much worse than what officials are admitting publicly. Let's talk about Germany. Its role makes this whole situation critical. Germany's economic decline isn't a sudden event. It's been building for 5 years across almost every major indicator. Industrial production is trending down. Export volumes are shrinking. Manufacturing orders are falling off a cliff. Business confidence is in a free fall. Its energy competitiveness has been severely damaged. Historically, when Germany gets a cold, the rest of Europe gets the flu. When Germany loses its economic momentum, Europe loses its anchor. Germany is supposed to be Europe's economic engine, the powerhouse that stabilized the entire Union through every single crisis before this. And right now, that engine is showing signs of serious structural stress. The data suggests Germany's decline might be deeper and last longer than anyone predicted. Germany just can't compete with Chinese manufacturing efficiency anymore. It's facing huge challenges with its energy costs, and its ability to subsidize weaker European economies is shrinking by the day. If Germany falls, Europe doesn't just slow down, it stops. But the structural cracks go even deeper than Germany. Why is this whole pattern speeding up right now? The European Union was built on two foundations: growth and stability. Today, the data suggests both of those pillars are starting to crumble. Wealthier countries in Northern Europe are showing less and less willingness to fund massive bailouts. Meanwhile, struggling countries in Southern Europe are becoming more dependent on EU support. Social trust is falling. Political instability is rising. Support for the entire EU project is declining in several member states. These long-term structural shifts look a lot like the patterns we've seen in past economic unions right before they weakened or fell apart. For those of us watching from the US, UK, Canada, or Australia, this matters immensely because Europe is a massive trading partner. If European integration weakens in a big way, global trade networks could face serious disruption. Watch this number carefully because it tells the entire story. What happens when trust breaks down? Before I explain the structural shift, look at this trend. It's the part most analysts are completely missing. Leading economists are warning that if things keep going this way, Europe could hit 3 critical tipping points. First tipping point: bond markets start rejecting new European debt at current prices. Borrowing costs spike, forcing governments to make impossible choices about funding basic services. Pensions could face cuts. Healthcare systems could come under pressure. Social tensions could explode. Second tipping point: banks tighten credit even to stable, healthy businesses. Investment slows, weakening the economy even more. Companies struggle to get financing. Unemployment rises. Tax revenues fall. Third tipping point: industries start moving out of Europe for good. Jobs disappear on a structural level. Manufacturing capacity shifts to Asia and North America. The economy enters a downward spiral that just feeds on itself. And here's what's so concerning. Each of these forces feeds the others. Debt forces spending cuts. Spending cuts weaken economic growth. Weak growth makes the debt burden even bigger. Higher debt raises borrowing costs. Higher costs force more cuts. There's no easy way out of this cycle. It just accelerates. This is where things break. And this is the part most experts won't say out loud. Major structural collapses rarely announce themselves. They develop slowly, quietly. They're often dismissed by officials who insist everything is under control, until one day, the pattern becomes impossible to reverse. For investors across the United States, United Kingdom, Australia, and Canada, your exposure to European assets, financial institutions, currencies, and trade might become a huge factor very soon. Are you prepared for what the data is suggesting? So here's the truth nobody is prepared for. Right now, every major indicator across Europe is pointing in the same direction. Down, debt is rising, banking stress is increasing, industrial capacity is relocating. When all these major forces align, the outcome becomes predictable, even if officials try to downplay it. Europe isn't facing a single crisis. It's facing what economists call a polycrisis, multiple negative forces all converging at the same time. Complex systems rarely send clear warnings before they hit a tipping point. They just hit it. And Europe? The data patterns suggest it may already be in the early stages. The question isn't whether something is happening. The question is, how long until everyone else sees it? Because once this pattern becomes undeniable, nobody will be able to ignore it. Because when Europe moves into a structural decline, the rest of the world follows. Because once confidence disappears, markets don't wait for governments. What do you think? Is Europe heading for a major structural crisis? Or can current policies turn things around? And more importantly, are you positioned for what comes next? Let me know your thoughts in the comments below. Thanks for watching, and don't forget to subscribe for more updates.